Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. Recessions are usually associated with falling asset prices. Stocks decline, economic activity slows, corporate profits weaken, and investors become increasingly cautious about risk. But interestingly, recessions don't affect every asset the same way. In fact, some of the strongest rallies in gold have occurred during periods of economic weakness, which raises an interesting question. If the global economy were to enter a recession, could that environment actually push gold significantly higher? To answer that, we need to understand something important. Gold doesn't rise simply because the economy weakens. What matters is how central banks respond to that weakness. Because gold is ultimately driven by monetary conditions, and recessions tend to change those conditions dramatically. Let's start with what usually happens when recession risks begin to rise. When economic growth slows sharply, central banks almost always shift their policy stance. Instead of tightening financial conditions, they begin preparing to support the economy. That typically means cutting interest rates, injecting liquidity into financial markets, and in more severe downturns, restarting large-scale asset purchases. Those policy changes ripple across financial markets, but they have a particularly powerful effect on gold. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. Now, the key mechanism here revolves around something called real interest rates. Real interest rates represent the return investors earn on bonds after accounting for inflation. When real yields rise, investors can earn stronger inflation-adjusted returns by holding government bonds. In that environment, assets like gold, which don't generate income, become less attractive. But when real yields fall, the opportunity cost of holding gold declines. And historically, falling real yields have been one of the most powerful drivers of gold rallies. This is where recessions become extremely important. When economic activity weakens, central banks often cut nominal interest rates aggressively in order to stimulate growth. If inflation remains persistent at the same time, real yields can fall quickly. And that combination, lower interest rates and stable or sticky inflation, can create a powerful tailwind for gold. But that's only part of the story, because recessions also trigger something else across financial markets: a flight toward liquidity and safety. In the early stages of a financial shock, investors often sell a wide range of assets to raise cash. During those moments, even gold can temporarily decline. We saw this during the early phase of the 2008 financial crisis. As markets seized up, investors sold equities, commodities, and even precious metals in order to raise liquidity. But once central banks responded with aggressive monetary stimulus, the macro environment changed dramatically. From 2008 through 2011, gold prices surged as central banks cut interest rates, expanded balance sheets, and injected enormous amounts of liquidity into the financial system. Gold rose from roughly $700 an ounce to over $1,900 during that period. That move wasn't simply about recession. It was about monetary response. Now there's another market that plays a critical role in this process: the bond market. When recession fears grow, investors often shift capital into government bonds because they are perceived as relatively safe assets. That surge in demand pushes bond prices higher and yields lower. Falling Treasury yields reduce the return investors can earn from fixed income assets. And as yields decline, the opportunity cost of holding gold continues to fall. So you end up with multiple forces moving in the same direction: central banks cutting rates, investors buying bonds, real yields declining, and financial uncertainty rising. When those factors align, gold often begins attracting significant investor demand. Now let's add another layer to the macro picture: the US dollar. Gold is priced globally in dollars, which means currency movements can have a powerful influence on precious metals prices. If the Federal Reserve begins cutting rates aggressively during a recession, while other central banks move more slowly, the yield advantage of holding dollars can begin to narrow. When that happens, the dollar can weaken. And a weaker dollar tends to support gold because it lowers the cost of gold for international buyers. But there's also a longer-term structural issue that investors increasingly pay attention to during recessions: debt. Global debt levels have risen dramatically over the past 2 decades. Governments, corporations, and households all operate with significantly higher leverage than they did in previous economic cycles. During recessions, high debt levels can create pressure on policymakers to support financial markets and economic activity. That support often takes the form of lower interest rates, liquidity injections, and expanding central bank balance sheets. In other words, monetary expansion. And historically, gold has performed well during periods when investors begin questioning the long-term stability of fiat currencies or the sustainability of monetary policy. Now, none of this means that every recession automatically produces a gold rally. The timing matters. In the early phase of a crisis, gold can experience temporary declines as investors scramble for liquidity. But once central bank policy begins shifting toward easing and liquidity expansion, the environment often becomes far more supportive for precious metals. Over the years, I've noticed something about the gold market. It rarely moves because of a single factor. More often, it responds when multiple macro forces begin moving in the same direction. Falling real yields, weakening currencies, rising financial uncertainty, aggressive central bank policy. When those forces align, gold can move very quickly. So, if recession risks begin rising in the global economy, there are several indicators investors should watch closely. First, real interest rates. If inflation remains persistent while central banks cut nominal interest rates, real yields could decline significantly. Second, the 10-year Treasury yield. A sharp drop in yields often signals rising recession fears and increasing demand for safe assets. Third, the US dollar. If the dollar begins weakening as rate expectations shift, that can create an additional tailwind for precious metals. And finally, central bank policy expectations. Markets constantly adjust expectations about rate cuts, liquidity injections, and potential stimulus programs during economic downturns. Those expectations can shift quickly, which brings us to the bigger picture. Gold's relationship with recessions isn't simply about economic weakness. It's about how policymakers respond to that weakness. If a recession triggers aggressive monetary easing, falling real yields, and rising uncertainty about the stability of financial markets, those conditions can create one of the most supportive macro environments for gold. And in a world where global debt levels are already extremely high, the next recession could provoke an even stronger policy response than previous cycles. Which raises an important question. If central banks are forced back into aggressive monetary stimulus during the next downturn, could the macro environment become even more supportive for gold than the last cycle? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.